The S&P 500 crossed 2,000 for the very first time this week. Jurrien, who's the head of global macro at Fidelity, stopped by the Financial Times offices in New York to explain why he thinks we could still be in the very early stages of a secular bull market lasting many years.
Well, I mean, we obviously don't know fully the answer until well after the fact, but there's definitely a school of thought out there that says that the Fed has intervened and manipulated asset prices, and that once it stops doing that, the markets will fall apart like a house of cards. And it's interesting to note that the Fed is almost done tapering. It will be, in all likelihood, in October. And here the markets are, with the 10-year Treasury actually very low and the stock market quite high. And so historically, there is some parallel to this, because one of the, not the last secular bull market, but the one before, which was in the 50s and 60s, started actually with the Fed ending QE back then, because back then it was monetizing the debt in the aftermath of World War II. And so the Fed was just as interventionist then with its balance sheet as it has been over the past 5 years. And the Fed ended in 1951, and the stock market did just fine, and bond yields went up, but they went up very gradually. So there is some historical precedent that it doesn't have to end with tears when it does end. Valuations, it's like beauty's in the eye of the beholder, and valuations, there are so many ways to approach valuation, because there's so many ways to look at earnings. You can look at operating earnings, estimates for the next year. You can look at trailing reported earnings. You can look at 5-year or 10-year cyclically adjusted earnings. So that's the Shiller PE. And that one is at a 26 multiple. The 12-month forward is at a 15 multiple. And so which one is the right one? And you can make any argument for any of them. But if you're reasonably confident that corporate earnings are going to continue to grow as they have, and they're sort of, the consensus is that they will grow at about 8.5% for this year. If that number is correct, then on a forward basis, the PEs are only around 15, which is not cheap, but it's not that expensive either. And remember that the 10-year cyclically adjusted number includes '08, which actually for the first time in history had a negative earnings per share number for the S&P 500. But it was on the basis, it was the result of a single company having a very large write-down. So maybe that 10-year number understates the true earnings power of the U.S. economy. As someone who deals a lot with clients and the media and the public in general, I've found that a lot of people are not really engaged that much anymore. So the S&P hit 2,000, and I get the sense it's like, wow, how did that happen? People aren't really paying attention. They've sort of lost interest. 08 was too traumatic. Maybe they're just not into it anymore. And I compare that to the end of the dot-com bubble, 99 and 2000, when the NASDAQ, it seemed every few months, was hitting a new milestone of 3,000, 4,000, 5,000. People were plenty engaged in that. And as soon as it hit one milestone in the media, they would be asking, when are we going to hit the next one? And I'm not seeing any of that now. So it tells me that maybe the public is more skeptical and maybe less invested, less engaged. And that, from a contrarian point of view, actually is bullish, because it suggests that everyone is not all in as they were during the last few major peaks.